The basis of evolution is that human beings are able to learn and adapt. They use new tools, and often the changes are not very visible in the near term. But when you zoom out, it becomes glaringly obvious. Does that hold true with managing money as well? Do we learn from the mistakes of the previous generations, or does history repeat itself as it does in so many other instances? This is Moneywise on NDTV Profit, and I'm Alex Matthew. My guest today has been writing about personal finance and investing since 1992, and I'm sure that he has answers to some of the questions that I just asked. Joining me today is Dhirendra Kumar, the Chief Executive Officer of Value Research. Dhirendra, thanks so much for taking the time. I want, through this conversation, to help our viewers see through the lens that you saw through in 1992 when you started writing, and through the years heading through that opening up of the Indian economy, the options available increasing for investors to where we stand right now. In your opinion, do you think that while a lot of things have changed, a lot of things have stayed the same?
The operating framework has changed. Every part of the activity, each activity, the way we do it has changed. But if you look at the behavioral part of it, if you look at the human drivers of those activities, when somebody was buying, making a deposit in 1990 and making a deposit in 2025, it's about the same. Making an investment, equity investment, is about the same. IPO, same. What was possible then and what is possible now, that has changed dramatically. Today there are open-end funds, IPOs, the way you invest, the way you sell, the way you buy, and the democratization of information. Earlier, I'll just give you an example of, when I started Value Research in 1992. My biggest advantage was that in my graduation years of 1987 to 1990, I was able to clip newspapers and tabulate the NAV of mutual funds.
Oh my goodness!
Over the previous 5 years.
Are you serious?
That is the root of Value Research.
Wow!
It was an Excel file, and there were and this was before setting up of SEBI. SEBI did not exist in 1992 in the current form. Mutual funds were not regulated by SEBI. There was a rule that mutual funds have to disclose their NAV every 3 months, and they have to publish in the next 2 months. So that was the state of disclosure, and they were primarily closed-end funds, but they were listed in the market. They used to trade every day, and so my biggest advantage, there was very limited information on these mutual funds. 80 of them were listed: UTI, LIC, GIC, SBI, Can Bank, Indian Bank, Bank of India. There were 8 mutual fund companies, and all public sector. No private sector participation was not permitted. So I had an Excel file which had starting date of the fund, when it is due for redemption, what is the most recent NAV, and what is the market price. And premium and discount to NAV was my primary thing. And I invented this mutual fund scorecard, which Economic Times agreed to publish every week. That was a revolutionary thing. Limited information, which was, there was this huge arbitrage. Who will take the pain of, putting it all together? And the moment I started doing it, it actually created a great furor about, what is going on. Before that, nobody questioned. The trading in those, those mutual funds was based on some, random, there was randomness in that.
There is randomness today as well.
Yeah, but there is a basis to it. Today, it is not possible to have a mutual fund with a NAV of 20 rupees or an ETF of 20, whose NAV is 20 rupee, trades at, cannot trade at 21 rupees. Because it will be in a narrow range. Otherwise, a ETF can be nullified or can be created. In those days, it was complete lack of information. So, having information, today there is a different problem. Today there is a problem of plenty. You had limited information then and making sense of it.
You have too much information.
And today you have to make sense of what is there and what is useful information and what is noise. What is just for the heck of it. A lot of people have this sense that they have plenty of data, they are able to, but they don't assimilate it, they don't decode it, they don't make sense, they don't really
analyze it.
Analyze and distill it into meaningful insight to guide their actions. there has to be a basis to it. So a lot of people think that a lot of information and they are doing some great research, and they are in that pretension, they do some big blunder, and those blunders are, primarily misplaced on false understanding of research with data and plenty of information.
Okay, so there are two schools of thought, Dhirendra. It is either that you oversimplify and therefore you make mistakes, or from the perspective of certain financial professionals, that you don't understand enough, as a result of which you make mistakes. Do you think it's one or the other, or do you think that it's somewhere in the middle?
It is not one or the other. Humans evolve. When think of how a person starts investing. You have limited money, and somebody tells you that why don't you invest in market? It is the ability to beat inflation. Or somebody introduces you that you can make quick money here.
Yes.
And somebody starts with trading, and in a rising market you'll make quick money quickly. You can actually dart your way to make some money,
which a lot of people did.
Which a lot of people do often. And in fact, it's almost a fairly regular thing that people are attracted to the market in good times, and they just square up their losses in bad times, and they go away forever. And that is a bad starting way. So that is where this whole revolutionary thing, that SIP, the convenience, your ability to automate your savings into market, that has really brought about, because my sense is that when you trade your way to making money without much of an understanding, it generally, good till it lasts, and then you are disappointed. And there is so much of disbelief in this that you really don't build anything concrete. You are making money, your assets are rising, and you don't think that it is sustainable. It looks like being lucky, buying a lottery ticket. The moment you do it with a method, you do it with little understanding, you start believing in the craft. You understand that why it is going on. And that, I think, is very crucial. So doing something with understanding has a reason, has a basis, and has its strength. I've always, this SIP boom that we see, this has really, people earn every month. People buy their houses on EMI. Why not invest? So far, it was not possible till about 10 years back.
And I would like to talk about that. But before we do, one major occurrence, something that has gone down in history, took place not too long after you started writing. And I'm talking about the big scam. Yeah. Some of what you're saying is similar to the kind of furor and excitement in the equity markets that we witnessed after the COVID-19 pandemic, where a lot of people made money very quickly. Obviously, I didn't live through that, or at least I was not old enough to understand what happened. I only have the experience of history and what has been written. But as somebody who saw that take place, who probably wrote about it, what did you see that you can draw parallels to today?
1992 was a completely different thing. 1992 was rooted in some fundamental shift happening. The Great Indian Reform that was triggered, coupled with the Great Indian Scam that happened at the same time. Somebody channelized money from the banking system into the stock market, which nobody knew, and that led to this, the madness. And market went up from 800 points on the Sensex to 4,000 points by May 1992. And even in those days, mutual funds were big. 1992, month of May, UTI launched one mutual fund called Master Gain. And in those days, I think it was about 4,800 crore. If you adjust that number, 4,800 crore to today's value of, adjusted for the value of Sensex, it will be something like 85,000 crore NFO.
Very substantial.
And this was from about, I can't recall that number of investors, but it was, so large. It was about 65 lakh investors actually invested.
Wow.
It is 1 out of every 20 Indian.
Wow.
In those days, invested in a mutual fund and in a closed-end fund. It raised so much of expectation. So you can understand.
What was the expiry, or what was the maturity?
This was an 8-year fund.
Okay.
8-year fund, a
Wow.
term, a closed-end fund.
That's quite a commitment.
It was amazing. It was unbelievable. And so much so that, I recall I was in Delhi, and people queued up. The UTI office was on the same place, Bahadur Shah Zafar Marg, where you have all these newspaper offices, Times of India, Indian Express and all, and the Gulab Bhavan in Delhi. And so many people turned up to get the application of this master gain that police had to do the bandobast, and there was a lathi charge on Bahadur Shah Zafar Marg.
My goodness.
This is the real news. This is a real story. Everybody wanted to buy this, invest in this master gain. And the context of mutual fund was amazing then. It was impossible for individuals to invest in stocks themselves.
Why was that?
Because most stockbrokers won't entertain you. Investing in mutual funds, investing in stocks directly was a very risky thing, because there was no dematerialization, there was no NSDL.
Yeah, you had a physical share certificate.
Physical share certificate, and physical share certificate had its own risk. You will sign at the back of it the transfer deed, and the signature may not match, and then it will be a bad delivery. So, and the brokerage used to be 2%.
And the settlement period was very long.
Was long, and then there was, the equivalent of doing at the start of the settlement to end of the settlement, there will be some badla and byaj badla, which was reverse of, selling without having one and buying without giving the money. So this particular methodology, it was very risky.
And so people went into mutual funds.
So mutual fund had a very significant role to play to democratize market, because in those days mutual fund investors could invest in market only through two vehicles: invest in IPO or invest in mutual fund.
Oh, okay.
And Master Gain was the third equity fund. The first one was Master Share in 1986, followed by two blockbuster funds of Canara Bank. They were amazing. They were a small fund, and they went up by 5 times in 2 years flat.
Wow.
The Can Share and Can Growth.
No wonder everybody wanted to get into
wanted to get into that, because 5 times, and then this Master Gain was followed by Magnum Multiplier Scheme 19. MMS 90 was early before that. This came in 1992. So that was another story. Magnum Multiplier Scheme 90, which went up by something like 16 times in 2 years flat. So it was democratizing stock market to common public in a very convenient format, and which was not otherwise accessible to them. And stockbrokers were not interested in entertaining all these investors, these small investors, because it was not worth their while. It was very risky.
So, but then what happened to this? Because I assume that after that you had the stock market bust, and people were locked in this, as a result of which they lost the gumption to invest. Is that what happened?
Not really. What happened was, this raised a lot of expectation, and the expectation which was raised to such an extent, they were disappointed to that extent. But if you look at the return of this Master Gain, which eventually got converted into an open-end fund, and today also it exists, and it's called UTI Equity Fund.
Right.
This fund has given an annualized return of little over 14% over such a long period of time, which, if you look at it in relation to fixed income, over these period, it will be 50% more than that.
Wow.
And from a portfolio, and in those days it was all speculative market, and a fund becoming so large and starting with such a disadvantage or advantage, I don't know, but it had access to a market which others did not have, and those were early days. So it was a completely distorted market, but I don't think investors were disappointed. Investors were disappointed because of their own expectation. Everybody wanted their money to become 5x, and it only became 1.5x. That was the disappointment, and that was similar disappointment was with Morgan Stanley, similar disappointment was with some of these funds. The real problem was that these funds were closed-end funds. People invested, and it was possible to sell these units in the market, and the units in the market were trading at 5x, 10x of their net asset value, because there was no information available. And the people who bought that, they lost it forever, because if you bought something worth 20 rupee for 100 rupee, which it was available, then you can only lose money.
There are a few instances of that taking place, very few instances of that taking place, and a few ETFs that allow you to invest in the equity market in the US, which is now trading significantly higher.
Yeah,
than
they are
the
trading
value.
at 25 to 30% premium over their underlying
And people
NAV.
are still going and buying.
They're still buying it. Yep.
So therefore, what I'm asking you, Dhirendra, is at that time it was a problem of not setting the right expectations. Do you think that that's the fundamental problem of investors that are getting into the fold right now, that have started over the last 3 to 4 years? Because if you think about it, despite what has happened since September, which is frenetic selling by foreign institutional investors in the Indian equity market, it has been a dream run since the bottom of COVID-19 to where we stand right now.
Yeah.
And a lot of investors that bought in at that time have had upwards of 17, 18, 20% XIRRs. So do you think that has created the wrong expectations?
Domestic equity or these
Domestic,
ETFs?
domestic.
Okay. Domestic equity, I don't think so. There could be pockets of overvaluation, or there could be, I have this feeling that people investing through mutual fund, if they are investing in any fund and they are doing their SIP, even the worst of fund manager cannot really hurt him. Simply because, the averaging and a growing market and the joy and the benefit of a diversified portfolio, unless you buy a fund which is very narrowly focused, a thematic fund which you have invested, which was, and you lose patience in between. Investing for the long run, investing regularly, and even a bad fund manager cannot really, hurt your
Dhirendra,
interest.
I firmly believe in this. And a lot of people do as well, which is why you have the fold of SIP folios rising constantly. But there are a lot of people, and you spoke about noise, but there are a lot of people that even in the comment section will say, what nonsense. Why are you preaching this kind of rubbish? These are the words that are used. SIP is all bollocks. Things like that. It gets really rude. How do you respond to something like that?
No, I think there's a merit in this, because what happens is the behavior is very different in a rising market and in a falling market. Investors' behavior, if your 100 rupee becomes 95 rupees, you are very upset. But your 100 rupee becomes 120, you are pleased. You are not very happy. So our reaction to losses and the sense of capital erosion, it has a far severe impact than the joy of appreciation, which could be very handsome, because it could be twice as much as the fixed income. So I take the point. The SIP, the moment you are able to bail out, you get out of a fund, you don't have the patience. Because the point of SIP is that you must invest through the lean period to profit from it. And the lean period is exactly that the first timer, the moment your 1 year SIP gets into losses, you lose your patience.
That's exactly what's happening right now, Dhirendra.
This is where the whole thing actually, SIP is not a mechanism whereby you make money. It's not an insurance against losses. It is not guaranteed to your profits. It is about averaging. It is a way of life. You earn every month, you save every month. Why not invest every month? And by averaging your investment, when you are investing at lower levels, you should feel happy about it, but you will feel happy about it only if you think that you are unlikely to need this money for 5 years. If you need this money after 6 months and the market will be worse than what it is today, it is better that you square up, because you came for the wrong reason. This is where the investor education, this is where the right selling actually comes into play. If you can have the finest of thing and people come with the wrong, expectation, they will be disappointed. Somebody was, just referring that electricity is very useful. But if you catch hold of it, if you use it the wrong way, it will hurt you.
It will hurt you. Okay, so I'm going to throw a few questions at you, Dhirendra, and this is just to utilize the kind of wealth of wisdom that you have accumulated over the years, and this will help my viewers as well. So, in your opinion, mistakes that people make when they're starting out, and I'm going to assume here that people are investing largely through mutual funds, right? Do you think that holding too many funds is a bad thing, and how much is the ideal? And how should you split between, should you use fixed income? Should you primarily be using equity? Should you also use hybrid? Because that's something that is available right now.
I think people should be investing their long-term money into equity.
Okay.
You should not do your asset allocation till you have, you need to do asset allocation. Once you have accumulated money enough that you need to de-risk yourself from a big fall.
So you start with equity.
You start with equity. And if you have crossed 40, you have never tried equity. Because, when you are in 20, 25, you have all the time, you are confident, and you also can withstand, and you will experience a decline soon after you invest.
Yes.
But that's okay. You can still withstand it. If you are starting at 40, then maybe, you start with a hybrid fund.
Sure.
You start with an aggressive hybrid fund or a balanced advantage fund. Simply because, your risk tolerance or the moment you witness a 20% decline in the value of your assets, not from the money that you have invested, but from
at the portfolio level.
But from the peak that you have witnessed.
Yes.
Because our mind actually gets anchored to the peak that we have seen with our own investment.
Yes.
Your 100 rupee becomes 120 or 180, and it comes down to 150, you'll get very upset. You will not see that, this 50% appreciation might also be very handsome.
Yes.
And this decline is very much a part of it, and that takes 10 years to understand.
Okay. So, and then how many schemes are too many?
It is entirely a function of your scale. If you are investing 5,000 rupees a month, one fund is good enough, and an aggressive hybrid fund is good enough. If you are investing something like 25,000 rupees or 20,000 or 50,000 rupees a month, then maybe 2 or 3 funds, 2 or 3 diversified equity fund. And by diversified equity fund, I would like to list those, the official categories. A flexi cap fund, or a multi-cap fund, or a large and mid-cap fund, or a value fund, or even a tax-saving fund, ELSS. They are diversified vehicles.
They're soon going to be redundant because of the new tax.
They're not relevant, but I would still like them simply because I think
the lock-in.
One is the lock-in. The other is that only individual investors invest in them, and they are not very large. When I look at these flexi cap fund, these flexi cap funds are way too big, and all the fund managers are saying that they like large cap more and this and that. But the truth is that they have become so big that they are forced to invest substantially in large cap, so they are almost like a large cap fund. And for them to generate that alpha is getting increasingly difficult.
Okay, let me ask you this then. In the flexi cap category, in your opinion, what AUM is too large? Beyond what AUM is too large?
I think
at this juncture, of course.
I think 60,000-80,000 crore is way too big, large. And there are too many of them. I'll tell you the reason. Flexi cap fund, if it is 60,000-70,000 crore fund, for sake of liquidity, assuming that this fund decides to invest or chooses to invest 10% into small cap, imagine how much, it will be 8,000 crore small cap portfolio.
And the free float of the small caps has been rising, but it's not to that extent.
It's very difficult. So I would say that, it gets difficult. And even if you succeed with your small cap allocation, the relative impact on the overall portfolio becomes completely blunted by this. It gets marginalized. So I would say that flexi cap funds are, not too big. And this is a great disadvantage. Some of the multi-cap funds are becoming very promising simply because they're forced to invest 25% each in large, mid, and small. So I don't know how they will be able to manage this, the problem of scale, because investors have, taken a fancy of these funds, and they're pouring so much money that it gets very difficult for them to manage.
But you did not mention a mid-cap fund. You did not mention a small-cap fund. Obviously, because it's not diversified. The same problems arise, and there are some very large small-cap funds as well.
Yeah. Yes, that remains a problem. And I think, there is one thing which has changed in the market, that with the emergence of these small-cap funds or growing popularity, and they're doing well, the depth in the small cap has also grown. Many of and not to mention that, these small cap funds are also 1/3 of the small cap funds is not small cap. That is by design. That is what the regulations permit. So to ensure that, they are able to handle the liquidity. And also when you look at those big small cap funds, look at the spread. It is 305 stock portfolio.
Okay, so we've spoken about how to construct a portfolio, and you've obviously said that SIP is the way to go. But I want to ask you this as the last question. In your opinion, and you've been writing about this for so many years, what have you most written about in terms of the mistake that somebody makes when investing?
If I have to look at one mistake which every investor does time and again, and does not learn is chasing recent past performance. It is investors' favorite pastime. Even if you have experienced it, if you have lost it, if you have, it has hurt you in the past, you will do it again. And it keeps happening every 5-7 years.
Okay, so stay away from recency bias.
Yes.
This is something that we speak about very often. Yeah. Unfortunately, we all fall prey to it, as you just pointed out. Dhirendra, absolute pleasure speaking with you. Thank you so much for coming by. All right, so we've given you some perspective. Dhirendra has given you some perspective, and this is something that you can use in your daily lives. Let us know what you think in the comment section, and do stay tuned. Lots more coming up on NDTV Profit.